In this video, I'll be going over some of the main criteria on how to select a good company to invest in for the long term. There are two main types of investing strategy when it comes to investing in stocks or shares: the defensive or passive investor, and the enterprising or active investor. The main strategy of a defensive investor is to select a selection of good companies or index fund and buy and hold them for the long term. The enterprising or active investors, which are also known as traders, use fluctuations in share prices to buy and sell for profit over the short term. Most people are more suited to the defensive investing strategy because they don't have time to analyze the charts and sit in front of a computer to trade all day. Many of the concepts that I talk about today comes from the book The Intelligent Investor by Benjamin Graham, who was the teacher of Warren Buffett. And Warren Buffett has famously said that The Intelligent Investor is the greatest book ever written on investing. Graham suggested 7 main criteria for selecting companies to invest in for the defensive investor. Number 1, an adequate size of the enterprise. A defensive investor avoids small companies because they are more subjected to fluctuations in the economy. Graham recommended that a company should have $100 million in sales, and this was in the 1970s. When adjusted for inflation, this comes to around $600 to $700 million in sales per year in 2019. Number 2 is a sufficiently strong financial condition. A good defensive company should have current assets around twice the amount of their current liability. This is also known as the current ratio. A company with current ratio of less than 1 should be avoided because they have more liability than current assets. And companies with a current ratio greater than 2 might mean that they are holding on to too much cash and not sufficiently investing in growing the company. Therefore, we are looking for companies with a current ratio between 1 and 2. Number 3 is earnings stability. We are looking for companies that have positive earnings in each of the past 10 years, and we don't want companies that actually lose money. Number 4 is dividend record. A company should have a consistent dividend payment for the last 20 years. Number 5 is earnings growth. A company should have at least 33% growth in per share earnings over the past 10 years. Number 6 is a modest price to earning or PE ratio. PE ratio is one of the most commonly used metrics for evaluating a company. It is calculated by dividing the price per share by the earnings per share. What it really means is the price that you pay for $1 of earning. So a company with PE ratio of 20 means that you are paying $20 per $1 of earning. Another way to look at it is that you are getting a 1 in 20 return, so a 5% return on investment. Graham suggested that for a defensive investor, the PE ratio of a company should not be over 15. It is important to note that tech companies often have quite high PE ratios because people often evaluate these companies based on their future earning potential. For example, Amazon has a PE ratio of 75 and Facebook has a PE ratio of 30. PE ratio by itself is not a good indicator of whether the company is undervalued or not, and it is important to compare PE ratio with other companies of the same sector. Number 7 is a moderate ratio of price to assets. Graham suggested that for a defensive investor, the current share price should not be more than 1.5 times the book value per share. The book value of a company is equal to the valuable of their tangible assets, which may include machines, buildings, cash, stocks, but not including intellectual properties, minus their current liabilities. The ratio of share price to book value per share is also known as the price to book, or PB ratio. A PB ratio of 1.5 means that the company's shares are sold at 1.5 times the value of the assets of the business. Some companies have very high PB ratios of more than 10, which may mean that investors see these companies as high growth companies. Similar to the PE ratio, the PB ratio is best used to compare companies within the same sector. Ultimately, Graham's criteria are quite strict, and you may end up with very few companies that fit all of the criteria. In that situation, you may loosen up some of the criteria, such as PE or PB ratio, so that you may get more matches. It is also possible that it's harder to find good bargain companies because we are still in a bull market. And during a bull market, many companies can be overvalued. If you are interested in learning about platforms to buy individual company shares or the best funds to invest in, check out my other videos. And as always, I will see you in the next one.